So let's begin with the online capital structure series, Equity Funding for Family-Owned Businesses. On behalf of the IMC Chamber of Commerce and Industry, I would like to extend a very warm welcome to all our participants, dignitaries, and our esteemed speakers, Mr. Utkarsh Sinha, Managing Director, Bexley Advisors, Mr. Jayesh H., co-founder and partner, Juriscorp, and Ms. Paula Maribala, founder and co-president, Stanford Angels, and chairperson of the IMC Startup Committee, for sparing their valuable time for the members of IMC. As we begin the session, may I request Mr. Ashish Vaid, President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, Mr. Vaid.
Thank you.
Mr. Just a minute, sir. Utkarsh, can you just stop the screen sharing currently?
Oh, sure.
Yeah. Okay.
Has it stopped?
No, not yet.
Okay. Once. Yep, I've done that.
Okay. Yes, sir. Now continue with the welcome address.
Thank you, Selvi.
Thank you.
So good afternoon, ladies and gentlemen, and a very warm welcome to today's session on equity funding for family-owned businesses. IMC Chamber of Commerce and Industry has been striving during these pandemic times to cater to the concerns of its members and associated bodies in guiding and supporting them towards managing various issues related to the business and its working during these catastrophically difficult times. As you all know, financing is the process of raising capital through the sale of shares. Companies raise money because they might have a short-term need to pay bills, or they might have a long-term goal and require funds to invest for their business growth and expansion. Many corporates are looking to cut their debts in these times by converting it to equity. A good case in the present times is, of course, of Reliance Jio, where they have raised from Facebook, TPG, KKR, Silver Lake, General Atlantic, a staggering 90,000 crores in these last 3 months. While we are all sitting empty, they raised a fantastic 90,000 crores. And what he does with it, whether he repays his debt or whether he uses it for business expansion, that's for all of us to see. It was recently reported that private equity funds recorded investments worth $45 billion in 2019. With more than 1,000 private equity and venture capital deals, India continued to be the second largest deal market in Asia Pacific in 2019, primarily due to the increasing number of large deals of more than $100 million, according to Bain & Company's India Private Equity Report 2020. Now, if there is funding, it has to be reciprocal return also. Obviously, money chases where they're the highest returns, in order to attract more funds and keep the cartwheel moving. Do you know Indian family-owned companies have delivered an average of 13.9% annual return since 2006, compared with 6% returns generated by their non-family-owned peers? Yes, India ranks third in the terms of the number of family-owned businesses, according to the Credit Suisse Family 1000 study, with 111 companies of $839 billion of market cap. Hence, this impetus given to family-owned businesses as their significant contributors in the economy of the country. In India especially, family businesses contribute around 79% of our GDP annually. In fact, as we all know, all our large corporates are family-owned, whether it be the Tatas, Birlas, Ambanis, Bajaj, etc. Yet, all of them have their own individual ownership structure and methodology of the shareholdings. India today is facing the impact of COVID-19, with major import and export destinations impacted, as well as the stock markets, which has taken a hit in the recent months. As we all know, when the pandemic broke, the markets crashed by almost about 40 to 50%, and they have recovered halfway since. And we are now at about in the Indian markets are down by about 24% as on today. In these tough times, financing has a major role to play for organizations, as funding is the only way to move forward, since income from trade and economy is almost at a standstill. A majority of investors expect the fundraising environment to be more challenging in the next 12 months. Cautiousness of a slow economy and limited partnerships are being selective with the increasing competition. Hence, IMC's Startup Committee felt the need to start this capital structure series, and the first in line would be the equity funding of family-owned businesses. This discussion would concentrate on the lack of debt funding for most family-owned MSMEs, restructuring and retiring existing debt, exploring the equity funding landscape, and examining the advantages or disadvantages of various capital structures, particularly equity in family-owned businesses. So as we all know, in the US, the interest rates have fallen to about 0% now. And also in India, we have been, with the continuous drop in the interest rates by the RBI, we are now at the repo rate of 4% and the reverse repo at only 3.35. So this makes a very good case now for people to put and invest money in capital of companies to encourage and promote businesses. Also, talking of equity capital, as we all know in the MSME packages, which was announced by the finance minister about a month ago. So that the first package was for 3 lakhs crores, which was for collateral funding of additional loan, which would benefit 45 lakh MSMEs. The second was a 20,000 crore package, which was for stressed MSMEs, which would benefit about 2 lakh MSMEs. And the third package, which is very interesting, is a new thought process where they release 50,000 crores and they're calling it a fund of funds. And the government for the first time would take a 15% equity stake in these new companies until they go public. And when they go public at probably a higher price, then they'll stand to gain with that. And that money would be reinvested in equity of newer companies. So this is even the mindset of the government, luckily, is that now they will start giving us equity instead of debt. So this is a beginning. I see a very good beginning, and going forward, it can grow to greater proportions. In today's time, we should not fight shy of selling equity in business, and as it not only brings in capital, but also at times it brings great value to the table. It gets know-how, it gets partnerships, it gets technology. So the person bringing in the equity, they bring a lot on the table. So businesses shouldn't feel shy of selling their stake, because you're still in control. I mean, until you are over 51%, you're in control. And all the large corporates, as we know in India, are controlled, I mean, by a public holding, but they are privately held as the majority is concerned, so that they can control the company. So today's events will cover below the following areas mainly. Firstly, restructuring, preparing and avoiding pitfalls, legal considerations in evaluating an equity infusion, safeguarding family interests and controls, key concerns specific to family-owned businesses, the advantages of professional versus family management, PE as a means to scale and sustain family-run business, fundamentals of raising private equity, case studies of successful and challenging PE experiences, an overview of the Indian private equity landscape. So there's a lot to cover in the next 1 hour or so. Dear friends, today we have 3 very renowned speakers. We have Mr. Jayesh H., co-founder and partner of Juris Corp. We have our own from the IMC, Ms. Paula Mariwala, founder and co-president, Stanford Angels and chairperson, Startup Committee, IMC Chamber of Commerce and Industry. Then we have Mr. Utkarsh Sinha, managing director, Bexley Advisors. So we are looking forward to an enlightening and interesting session ahead. And I'm wishing you all of you a great learning to capital raising from our great experts today. So over to you. Thank you.
Thank you so much, Mr. Well. I think that was a fantastic introduction, and I think most of what all of the speakers would have said, you have covered in a nutshell. So you've cut our task down to a very simple exercise. So I think without further ado, I'll just start sharing my screen. Give me 1 second. Sure. So as Mr. Ved said, the objective of this session primarily is to introduce a new, what is an underdeployed, source of funding in the family business space. Now, if you think about it, if you think about your capital structure, you've got debt, and debt is something which family businesses are very well aware of. It's something which has been deployed traditionally in India to great effect. But using debt alone is like going to a 2-gun fight with a single gun. you have the equity part of your capital structure, which is something which can be deployed and to great effect. And deploying equity as a tool which you're using as as a promoter gives you the ability to even use debt more effectively, even get more value for the amount of debt that you are able to raise. So I think the fundamental goal of this session is to talk about equity as an asset class for family-owned businesses, and also to discuss whether it is the right source of funding for you, and to discuss that if you would like to go for something like that, then what are the things that you need to do. So we'll divide this into 4 sections. Section 1 is I will just talk about a very high level introduction to private equity. So what is private equity? What are the mechanics of private equity? Why is private equity needed, and how do you prepare for private equity? What do you do with the money that you raise from private equity? We'll then shift to Jayesh, who will bring in a transaction perspective, especially from a legal background. What are the different structures that are deployed during a private equity transaction? How do you safeguard some of your interests? How do you make sure that you are able to maintain issues such as control, issues such as liquidity? How do you maintain those? And finally, Paula will bring in a dual perspective, one of being an investor herself, and how does she look at family-owned businesses, and what are the challenges that she confronts? And secondly, from the perspective of coming from a family business herself, in fact two. So she will talk about the perspectives from the perspective of a family. So without further ado, let me just jump in. So I think this first slide covers what is a private equity. So and I think the way to start about it is to talk about what is the structure of a private equity fund. Now there are 3 key entities that you look at when you're looking at a private equity fund. In the middle, you will see we are talking about GPs. GPs are the folks that you most hear about. So when you think about a KKR, when you think about a Blackstone, when you think about a Chris Capital, who you're thinking about is at the GP level. Now, there's a small nuance over there, which is that, and GP stands for general partner. Why general partner? Because these are the partners who are actually managing the business. What is the role of these general partners? First and foremost, they have to, raise the funds for deployment. So GPs typically go to what we call as LPs. LPs are limited partners. So limited partners are also partners in the fund, but they are the contributors of the capital. Typically, these are folks like large insurance companies, large pension funds. In the Indian context, folks like SBI, LIC, their treasury operations. They seek ways to diversify their holdings and make sure that they're able to diversify the risk profile that they hold. And therefore, one of the asset classes that they choose to deploy is private equity. So therefore, LPs have, LPs typically have a large pool of money. A pension fund will have money from the pensioners that they're managing. They'll put a lot of that into direct public markets. They'll put that into hedge funds, which are investing in public markets or other instruments. And one of the asset classes that they also deploy is private equity. So the money comes from LPs. Once that money has come to the GPs, it goes into funds. So each GP will typically raise more than one fund. Each fund has a life cycle of about 5 to 7, maybe 10 years. Now, what happens in the life cycle of a PE fund? Now, so for example, if you think about a fund which is launched in 2008, 2008 and 2009 would be typically the years in which the fund is going to the LPs and raising the capital for it to deploy. And in the meantime, as the capital starts coming, they start making investments as well. So the first 2 years are heavy on raising the funds, but at the same time, there's some emphasis on starting to deploy those funds as well. The next 3 to 4 years typically for a fund are the fund's investment period. So this is the time where, sorry, give me 1 second. Yeah, this is the time where, the funds are going to, find the right kind of investments that fit with their thesis. They'll evaluate the companies, they'll put the money, and then they will do active portfolio management. So they'll make sure that the companies that they have put the money in are able to grow, are able to, fulfill the thesis that they came to the market with. And finally, the last couple of years of a fund are what is called the harvesting period. So that is when the funds actually try to make exits. Now, what is an exit? An exit can be you can take the company public. So you take the company, you have your stake, you make it listed in a stock exchange, and therefore you get some money back. B can be that you sell to another company. So if you think about the context of an agriculture company, you get it to a certain level, and then you sell it to a larger agri player. A tech company gets to a certain scale and gets acquired by a Facebook or a Google. So, or the third is that there's a merger. So you create a structure in which two companies of similar size, similar scale come together, and the investors get an exit at that point, and the managers and the promoters stay back, and there's some equity sharing agreement. So these are typically the ways in which a fund makes an exit, and at that point the fund then starts returning money to the LP. Now, what is of critical import over here is to understand how a fund makes money. A fund is making money in two ways. The first is in terms of its management fee. So every fund, suppose you raise a fund of 100 million, you then are able to charge the LPs a management fee every year of your operation. And typically, depending on the type of the fund that it is, the stage of the fund, and the size of the fund, this can be anywhere from 1.5% all the way to 3.5%. So that is that is the money that the GPs charge the LPs on the fund that they have raised to make sure that they are able to do their job well. The main money that a GP makes is through the exits that they get, and for that there is something which is called, typically it's a 2-20 arrangement. So 2 is the 2% management fee, and then they will take 20% of the profits that they generate. So suppose they invested 100 million and they're able to get that up to say 300 million. 200 million that they have made as profits, uska 20% goes back to the GP, provided that they are able to meet a certain hurdle rate. So as long as the IRR, the internal rate of return for the fund, hits a certain milestone, then they are eligible to draw that 20% aspect. And again, that varies from fund to fund. That varies from a credible fund, which is a long-term fund, is able to charge a higher management fee and a higher performance fee. A newcomer is able to charge lower. But the main way that a fund makes money is through the exits that they make. Now, the reason that this is important to note is that there are a lot of misconceptions about private equity, especially about LBOs, about the fact that these are they are asset strippers. They are people who are trying to get the highest amount of value by liquidation. That is in most cases not a good strategy for an LP, for a GP, because that is the way to realize the minimum value. If you think about it in very nuts and bolts term, फैक्ट्री बेच के आपको पैसा नहीं मिलता, फैक्ट्री चला के आपको पैसा मिलता है. So that is the mentality with which a good private equity fund is going to come into a transaction. So that's part one. And again, I think briefly the types of funds which are out there. There are LBO funds. LBO stands for leveraged buyout. What that means is that besides the equity that they put in, they also borrow and put in debt into the transaction, and the debt stays on the balance sheet of the company that they are putting the money into. LBO transactions are typically rare in India. There are very few AIFs, which is alternate investment funds, which is what the SEBI registration is known as for VC or a PE fund. There are very few who have the AIF 3 categorization, and Jayesh, let me know if I'm wrong over here. And therefore very few deploy debt as as a means to enter an investment. Most companies will be deploying pure equity. There's venture capital, which is like private equity but early stage. And the thesis behind venture capital is that you take lots of bets, very small bets, and you hope for outsized returns on some of them. So the idea, the word venture capital comes from, in a way, adventure. So the idea is that it is not a sure shot. You're going to take bets, and some of them will pay off, some of them will not. But the ones that do will pay out with outsized returns. So you're able to, to make your fund. So for example, if you think about something like a Y Combinator, the early funds were made by 1 or 2 companies in their batch. So, the marquee investments have been things like Airbnb. So, you get a unicorn in your midst and you're able to return the fund many times over. What is of most relevance to us is growth equity. In the Indian context, growth equity can be anywhere from $10-20 million all the way to $100 million. And these are investors who are looking to put money into early stage companies who are just now ready for the next stage of growth in their lives. Typically, these are companies who have, in an Indian context, either an IT tech kind of a background, or it is a manufacturing background or a services background. But the critical thing to note is that you have to have reached a certain level maturity before growth equity is attractive, is a possibility for you in India. One of the challenges is that the growth equity landscape in India is not as mature as it is in other markets. So if you think about a market like the US, where we are right now in 2020, I think they would have been in 1970, 1980 in terms of the maturity in the private equity market, and I think they really took off in the 1980s, where a lot of early stage funds were available, and they were buying out a lot of family-owned businesses, managing them, getting them to the next level of operation. So growth equity is what is the most interesting from the perspective of our conversation today. Then there are real estate funds, there are infrastructure funds. These have both, started doing really well in the past few years after the introduction of REITs and InvITs by SEBI, real estate investment trusts and infrastructure investment trusts. And finally, there's some special situation funds which are specific to the challenges that you're facing, and they are restructuring funds. They can help you clean out your cap structure. But again, for most early stage family-owned businesses, these are not typically the options. So from our perspective, what is most relevant today are growth equity funds, and in some cases, traditional private equity funds if you have a certain scale and size. Let us talk about why private equity, and I think again Mr. Vaid covered a lot of this in his talk. One of the main reasons that private equity is something which we should be looking at right now is that credit is increasingly is becoming dearer in this environment, and there are multiple factors that are driving it. I think one of the first factors that kicked this off was the revised banking norms that came out in 2016. After which banks were forced to recognize a lot of NPAs which they hitherto could have ignored, and the act of recognizing those NPAs meant that their ability to take risks went down. Suddenly, banks which had 2%, 3% NPAs were having to report 10% NPAs, and therefore they inherently a risk aversion entered into their approach, and that has had a downstream impact on the access to credit for MSMEs in particular. Second factor that has affected this has been, right now the global slowdown is something which is really, giving a big crunch to bankers. And third, I think there's also been a factor about risk aversion in terms of bankers being personally liable to a lot of, decisions that they make. In case you're, putting out a loan and it goes bad, there's nothing stopping, a vigilance inquiry or a CBI inquiry against you. So there's a lot of risk aversion in terms of bankers' mentality for giving out, debt. So these factors have led to a slowdown overall in access to credit for MSMEs. And the rise of NBFCs was one factor which was countering that to an extent, but the rise of NBFCs was in turn making capital more costly. So earlier in 2014, you would be able to get a bank credit from a bank directly at X%. That bank was now more comfortable giving that money to an NBFC, and an NBFC would then lend to you with an X plus A%. So the cost of credit became dearer from the perspective of a family-owned business. Now, if we look at the trends, not only has the rise of NBFCs in credit distribution been rising, the overall credit deployment has also declined. Especially in the last year, there's been a decline of about 1.9% year on year. So because of these factors, there is a decline in the most traditional, most comfortable means of credit available to you as a family-owned business. So that is one reason to look at private equity. The other reasons to look at private equity are, number one, as I said, is decline in credit. Number two is, once you get private equity, there is a professionalization of your management. There might have been challenges that you've been struggling with in hiring and recruiting the top level of folks. Very often it is a function of the compensation that you're able to give, and also for a lot of professional managers, there's inherent fear and about entering a family-owned business. Once you have private equity, a lot of that fear evaporates. The presence of private equity on your cap table gives comfort to the most talented folks to come in and take senior level positions and run the company in a professional way. And also, I think the private equity, a private equity fund which is worth its salt, will try and enable that as well. So they will try and recruit and install the right kind of managers for you. The third factor, which is very important, is that once you take in private equity, you get access to capital downstream. So, not only do you get access to further rounds of private equity down the round, but your credit worthiness and your access to credit also improves. The fourth factor is that, this is a way of diversifying family wealth. So if you think about it, if you own 100% of a company, today it's like putting all your money in one investment. So if you wanted to buy a share, you would not, even if you think that Reliance is going to do very well, you would not put all your money into Reliance. You would try and diversify that. In effect, you're doing that yourself, in terms of the greatest wealth that you have, which is all diverse, concentrated in one asset, and your fate is tied to the outcome of that. Raising private equity and making partial exits helps you to diversify some of the wealth that you have. And finally, there's an opportunity for returns and liquidity, down the line. So, the ability to be able to make your wealth grow a lot faster and have that wealth available to you as liquid cash rather than as an ownership stake in a company which is very static. So some of the largest corporations that have been created globally have been created by fully deploying their capital structure. So briefly, let us just talk about, what is the way that a private equity makes money. So there are two factors. On the right hand side, you will see, factors which are company driven, and on the left hand side, you'll see factors that are industry driven. And this is from the perspective of a private equity fund. As I said earlier, value creation is core to the private equity model. The only way that a private equity manager makes money is if he or she is able to make their portfolio companies grow. And there are three ways that they do it in terms of the company. One is that you have to drive growth in revenue. Once you get private equity, you'll have access to the best brains who will help you strategize on how to tap adjacent markets, get deeper access and monetize your existing customers better, and how to expand into additional products, services, or markets. Then there's the factor of improving margins. So a private equity is going to come in with a scalpel and try and get rid of additional costs which are not necessary. So they will improve input costs. Very often, being a part of private equity also gives you access to increased bargaining power. There is going to be some reduction in COGS, or in some cases there might be an investment in COGS in the short term to drive top line. And there will also be some monetization of fixed assets. So for example, if there are assets that you hold which are not giving you the best returns possible, and a private equity fund is going to try and monetize those assets. And if you need to use those assets, then use them as capex, as opex rather than capex. Third factor is that there's going to be an altering of the capital structure. A lot of, as Mr. Vaid also said in his intro remarks, one of the main reasons that a lot of people start thinking about private equity is to retire their debt. And private equity is one of the most common means of retiring debt. I've put a slide in since he mentioned it of Geo, which I'll come to later on. But even if you don't look at the scale of Geo, smaller companies, and we'll get into some examples, have used private equity to retire debt, which has become very expensive, and have the ability to do more with the money that they have. And also, of course, to deploy equity for growth. Then there are the industry factors that a private equity fund is counting on. They're counting on the fact that there's going to be an improvement in multiples. So what do we mean by improvement in multiples? So for example, your EV, which is your enterprise value, which is your the sum of all your share capital plus all of the debt that you have, in a very simplistic way, to EBITDA is a ratio. The EV to EBITDA is a ratio that most investors look at. They are counting on the fact that the EV by EBITDA ratios are going to improve over time, which means that there are going to be some trends extraneous to your company that are going to drive an improvement in those numbers. So they are coming in right now in what they believe is a market which is on the rise. So that is one thing which drives the motivation of a private equity company to come in. And then, of course, the fact that there are certain sectors that they believe are going to do well, there are certain geographies that are going to do well. So those drive some of the investment decisions. Then the fact that there's going to be a rising GDP and consumption, and that is the most potent selling point about India, the India growth story. We can debate how well it's doing right now in this environment, but again, I think right now we are in a globally suppressed environment, and there's a study by IFC and the World Bank which recognizes that despite the slowdown, India and China are going to be the regions that end up have positive GDP in the next couple of years. India is projected to have 2% next year and 6% the year after that. So even in this environment, India is faring better in comparison despite being suppressed. India has an openness to FDI. FDI policies are being reformed, and that creates an opportunity for growth. And of course, India has global competitiveness on a lot of different fronts. So that becomes a factor which drives investment decisions. And finally, there are going to be some industry trends that people who are in private equity predict down the line, specific to the industry, whether it's consolidation, whether it's mergers, whether it's the forces of globalization, whether it's digitization and technology adoption. So these are some of the factors that motivate a company to put money in. Very quickly, I'll give you a few examples of family-owned businesses that have raised private equity. And I'll circulate these slides afterwards so that you have a chance to look at these in more detail. But just to give you an example, Bikaji Foods, took on private equity because they were considering an IPO, and they wanted to make sure that they have private equity on their cap table to be more attractive as an IPO candidate, and B, drive the improvements in the multiples that we just talked about. We can think about Bharat Serums, who funded a lot of their growth with private equity. A lot of their factories that they installed, a lot of the plants that they installed were funded by private equity. We can think about Keventer Agro. The pouch milk business, which was sold on Metro, they raised equity to make improvements in their plants. We can think about GVK Bio, which raised private equity to grow through acquisitions. So they raised the money to be able to acquire a lot of smaller players and increase their scale. We can think about Godavari Biorefineries, which raised private equity to fund new manufacturing plants and in specialty chemicals, and also to make some acquisitions. So there are a lot of things which can motivate your decision to raise private equity. Most of them are going to be growth driven. Some of it can also be driven by the fact that you need to consolidate your position, you need to retire someday. And finally, a quick snapshot of some of the players who are active in the space that I discussed early on, which is the growth equity stage. These are all funds who are deploying capital in the ticket sizes that are attractive to family-owned businesses. And once you are able to raise money from these sets of folks, you're able to take your operations, grow to a certain level, and then enter into conversations 2 or 3 years down the line, 4 years down the line, with the players who are able to put in $100-200 million checks in a single go. So that is a brief overview of the landscape. This is the Geo transaction. Since Mr. Ved was speaking, I just put this in there. This is just for your information. And finally, I'll just take 5 seconds to talk about what is the role of an investment banker in a private equity transaction. Investment bankers are fundamentally enablers of wealth creation. And what I mean by that, is wealth is one of the chief ways of measuring economic output. When we talk about creation, we're talking about directly or indirectly always having an impact on a net positive impact on the creation of wealth. And finally, we are enablers of the flow of capital. So I think the role of an investment banker is always to make sure that capital does not clump up and get stuck in one place, but it keeps flowing. The ways that we do that are by creating efficiencies and optimizing the use of capital. So as we talked about earlier, the capital structure of a company, making sure that you're deploying all of the firepower that you have at your hand to get the maximum value. So this is an overall overview of the private equity space, and we'll take questions after this if you have any specific questions that we can cover. And I'll now hand over to Jayesh.
So you're mute, just a minute. Just a minute, Mr. Jayesh. So please unmute from your end. No, you're mute. You're mute. I have unmuted you. Yeah. Now you're. Okay. Hello. Hello. So you're unmute. Please unmute. I have unmuted you. You have to unmute from your end. Yeah, Mr. Sinha, done.
Thank you. Jayesh, just click on the unmute button over there on the bottom left. Bottom left.
Bottom left. Bottom left. Bottom left.
Now we can hear you.
Now we can hear you. Yeah.
Yes, thank you.
Okay. Yeah. Thank you.
Let me just put this into the slideshow.
Yeah.
Yes. Okay. Thank you, Utkarsh.
Okay. Thank you.
Thank you for that support.
My pleasure.
And thank you, Mr. Wade, for the introduction and a couple of points which you raised in the beginning, and I'll use that to start off with. Uh, Retiring existing debt, of course, is a very valid perspective and the use of funds. And then about raising capital as to why you want to. And somebody did throw in a query right now that can promoters sell out? And Utkarsh also mentioned this about diversifying family wealth. And it's like you won't have a single portfolio, single asset portfolio. So from a wealth perspective, why should you have a single asset business, so to speak, where everything is, everything is in the same business and there's no dilution. So let's just start with this presentation, giving a perspective from a lawyer's perspective as to what are the things you need to keep in mind, including expectations of the investors and what things can come in the way from getting for you to get a good value for yourself, and value not just in valuation terms, that matters of course, but value also from a contractual obligation which you end up undertaking or restrictions which you can have imposed on yourself. So I'll just proceed with that. Uh, just to give you a big picture perspective, and here when we talk of the holdings, what we're talking about is your shares in your company, operating company, are held how? Are you holding it as individuals, HUF partnership structures, or some of, increasingly we see family trust being set up, part of estate planning, etc. And in lesser instances, but becoming slowly a bigger percentage, the shares in the operating company are held by what we would call a holdco or holding company or a family investment company, etc. External investors are far more comfortable when they see shares being held through a holdco. It gives them significant risk mitigants. And I put this up, so I'm not going to spend too much time talking of all these various aspects. But we have used color coding intentionally, so that will give you a fair idea as to what we mean, and there's legend at the bottom. I will talk about a couple of key points here. From a liability for promoters, of course, your liability is maximum when you are holding the shares in your individual capacity, whereas when you are holding the shares through a corporate vehicle, including LLPs, it enables you to not only ring fence your liability, but also it enables you to do further deleveraging even at the holdco level. So, and this becomes, as you get bigger, this may become more opportunistic, where you don't want to directly dilute in the operating company, but you rather dilute a bit in the, your holding company. And therefore, again, this is a very valid aspect. The converse is the true from a control perspective, that, from a, if you hold a corporate vehicle, control issues compared to holding it as an individual, etc. But that's where the trade-off has to be done. And we had around 3 years back a very interesting situation. There was this family business, diversified. One part was into poultry, another part was into energy, renewable energy, and they were wanting now growth capital to come in, and it took us almost 2 years to put it into a vehicle where external investors would be willing to touch it and give good valuation. Things included, family-owned land, which was sitting in a partnership, was being used by one of the business companies, but no arrangement or documentation into place. The trademark was vested somewhere else. So cleaning up all of this and structuring it in a manner which is tax efficient, including in India stamp duty issues, it took us time. And when you have different family members sort of controlling the different set of assets, it takes longer to get everybody to onto the table and come to a sort of a common understanding, because when different family members control sort of different elements of those assets, there are concerns to be addressed, including like, will my importance diminish? Will the control which I have go where and be in somebody else's hand, and so on. So uh, the earlier one starts, the better it is, because these things do take time. What we have done here is set out the various types of instruments, and we have also graded them. We mostly think only of equity as equity raising as means you issue equity shares. It need not be so. And Mr. Ved made a very valid point in the beginning. Family-owned businesses generating 13.9% returns, whereas non-family 6%. But he also talked about like funding is all about reciprocal return. That which is in my terminology, risk versus reward, and that's why hybrid capital can play a bigger role. Equity has the highest risk from an investor's perspective. Therefore, they will want the highest returns, which is full upside. Debt has a lowest risk comparative to the other instruments, and therefore, the returns get capped. The hybrid is where you decide, are you going to be more equity oriented or more debt oriented or what? And then you can do a amalgam of, okay, I will give you upside sharing in the wealth creation, but I will cap you at some stage. Or the other way, other end, which is more debt like, which is, okay, I'll give you lower interest, but a part of the upside sharing, which is like, if otherwise I were to pay, for an MSME, say I were to pay 15%, okay, I'm going to raise fund at 8%, but, whatever value I generate, I will share, say, 15% or 20% of that value in the next 5 years. So those structures can be created, and that's why we have these plethora of instruments available. I mean, there are some more, but we try to keep it simple. And it's worth definitely examining from a perspective of what do the promoters have in mind from a 5 to 10 year horizon. What type of investors are we dealing with? And Utkarsh mentioned about growth oriented or growth equity funds. Most of them are happy coming in at the pure equity level, but there are increasingly other funds around which, for given their own dynamics, who their LPs are, etc., would prefer more regular annual returns and only some upside sharing, or lower quantum of annual returns and more of upside sharing towards the end of the fund cycle, etc. So it's a combination which we have to keep in mind, and normally what we end up doing is, this is a role where the investment banker plays a key part, determining what is the optimal structure, and our role is to highlight what flexibility are there or it's not there from a regulatory legal perspective, Companies Act and other, and depending on the licensing involved, if any of the businesses have some sectoral licenses issues, etc. So again, giving a different cut on when debt, when equity, or hybrid, etc., and what are the impact from a perspective of dilution of stake, payout, tax. We have kept it simple. I mean, so it gets far more complex than this, but for the purpose of today's webinar, we have kept it really simple. And you need to look at it from both perspectives, your perspective, of course, but also from the investor perspective. So the greater flexibility you are willing to demonstrate, the easier it becomes to do the transaction and to attract the right type of investors. And ideally speaking, you want an investor who's going to be with you for the next, if not 20 years, at least 5-10 years. And maybe they hand over the baton to somebody else, because as again Utkarsh mentioned, most of the investors are now funds which have a limited life. Yes, some funds have the ability to transfer investment from one fund when it's expiring to another, but it's not something which they're willing to commit upfront, and therefore they will look for clear exit mechanisms, and I'll come to that a little later. So now, on what basis do you decide which instrument to use, when, etc.? And again, we have put some big picture points out here as to what are the criteria to keep in mind, and it works both ways. So I'm not going to again spend a lot of time on this. I'll talk of one particular transaction we did almost a decade back, but still one of my favorites to talk about. A very large transaction, but this was a very large real estate group, had taken a large amount of debt financing, and I'm talking about around the global financial crisis, just before that, around a year before the global financial crisis broke out. And now they were thinking of doing an IPO, but they still felt that a large part of the real estate holdings were not mature enough, and therefore they will not get the right value if they IPO'd at that point of time. So the structure we created was creating a CCD structure, but our clients were concerned that if we don't have any equity stake, how do we have certain statutory protections, mismanagement, minority protection, etc. So we created a differential voting rights type of structure of shares, so-called Class B shares, which gave our clients a 10% plus voting rights and ability to therefore get statutory protection and certain other rights, etc. But without really having a participation in the economic upside. Because the economic returns were on the debt-like instrument, or CCD, and if when the IPO were to happen within a time frame, then a part of the increased valuation from the date a client invested in to the valuation realized at the IPO stage, a part of that different share would have come to our client on the instrument. But therefore, the point is that didn't give them equity shares upfront. So we created a structure which allowed our clients to get those protection. Here I was acting for the investor. Now you need to keep these things in mind because ideally speaking, in today's time, everybody will feel, oh, while I want equity, not at today's valuation. So how do bridge this gap? And that's where hybrid instruments can play a great role. That okay, you tell an investor, he says, but I have no clarity next 6 months, 1 year, what the hell is going to happen. So how do I believe your projections for the next 3-5 years? So the via media is allow the investment to happen in a manner that the investor gets a comfort that today's valuation is his protection. But if the returns get generated because the business does pick up as you're projecting it, you as the owner, then the investor gets to dilute at a midpoint of say today's and future valuation, say of 3 or 5 years from now. But you're getting the money now, which means you can retire expensive debt, and or you are having money to more than survive for another day or even grow in these times, which can be very difficult otherwise. So look at it from a perspective of diluting in these times to more than fight the battle and to fortify yourself, and at the same time giving the investor a via media whereby they are not stuck with high valuations which may never materialize, and they have some downside protection coming to them. So that's why this portfolio of instruments can really help in achieving that. So sorry, I made this point earlier, is equity customizable? If you look at pure equity, answer is of course not really. But if you start looking at shares with differential rights or hybrid instruments, etc., it is then customizable. And when we talk of customization, we're talking of, again, creating a common point, midpoint between investors and the promoters. Investors are little uncomfortable if they see the promoter wanting a significant exit upfront itself. And that's, again, somebody asked this question. It's not that they are averse to promoters exiting upfront, but not a full exit unless it's so this is where the dynamics come in. If it's a full 100% sellout, it doesn't matter then. But if it's not, if the promoter is saying, oh, I want to sell out, 50-60%, but I want to retain control, then the investors will really take a hard look as to, why is this person wanting to do a majority sellout, but wanting a sort of full control, as in 51% plus control, and how do we protect ourselves? So those are the situations where, again, you need to look at differential equity models and create, again, a via media where both the sides' expectations can be met. One common structure is what we call earn-out deals. The investor agrees, okay, you know what, I'm willing to buy you out, say at 70%, okay, but I will pay only for 40% right now. The balance 30% I'll pay on the basis of performance meeting projections over 3 years. In fact, we are dealing now with some situations where transactions like this were done, say 12, 18 months back, or maybe even 2.5 years back. And now the promoters are worried that, do they get some breathing space because the third year projections are definitely not going to be met. And our advice has been to, to try and work out extension of time, etc., and not get into disputes, but that's a topic for another day. But to come back to the point, earn-out structures are a great mechanism and really, worth keeping in mind to, again, bridge the gap between the promoter expectations and the investor expectations. So some of the terms, and I don't want to get into jargon out here, but and these slides are anyway going to be put up afterwards, so you have this with you. Key things, and when we talk of merger JV, what we are saying is also it is going to, I think, happen more. It's it's not been so common till now, where sometimes the investment comes in by the investor telling you, but I have this other portfolio company, and we create a merger, there'll be great synergy. It could be downstream, upstream, whatever, horizontal, vertical, doesn't matter. More from a perspective of the investor having greater comfort that they can do scalability and realize value faster, or greater certainty of realization of value. So don't rule out opportunities where you're getting to merge into some other entity or do effectively a joint venture, which could even be by hiving off a business from your own current businesses, etc. What you need to look out is what is your role and responsibility and control in that emerging entity. It may well be that you become a minority in that emerging entity, but if it's only a part of a business which is being moved out, it could actually be a good deal. So it's something definitely worth considering, and that's where the synergy aspect comes in, as to how was the investor and the promoter expectation getting aligned. The other thing keeping in mind is the future fundraising. Are there any restrictions, etc., or is the ability getting hampered, especially when you're in majority? Now, from a PE perspective, control is the key. I mean, I rarely get to see a PE deal where the investor doesn't want some veto rights on certain aspects, and this is beyond the statutory ones, where they can block certain actions, etc., or you need their prior positive consent to do certain actions. These have to be well thought of and negotiated. Now, simple example would be, okay, annual business plan to be approved, and you can't incur any expenditure plus minus 1% of what is there in the annual business plan. You need to be mindful of these things, because and your business plans will become very, great sanctity will get attached to it and rigorous. But you may not want to agree to a plus minus 1% delta. You may want to say, okay, but give us 10% delta, or in the business plan, allow us to put in, if you're creating a business plan of, say, annual business plan of, say, 50 crores, then put in, like, something like 7-10 crores of variable, which is left to the discretion of the current management, or stuff like that. So that's where, you negotiate control mechanisms in a very meaningful manner. On a promoter restrictions, there can be significant restrictions on, can you do other businesses? Can you, get into invest in other businesses passively or not? Dilution restrictions, transfer restrictions on within the family. Can you transfer easily or not, etc., and all of that. Now, in the exit, and some of the biggest disputes in India happen on the exit mechanisms. I mean, many of you are familiar with Tata Docomo. That was an exit-related issue, but a different category, but still. Most investors, would want clarity on exits. If it's a pure PE, they will expect you commit in some manner to an IPO or a sellout, etc., or they will want to have a tag drag, right, which I'll cover later. Some of the PEs, which are more, the hybrid types, will want, if they don't get an exit, they will want, sorry, I don't know why that happened. They will want a put option on you, as in the promoters. Now, again, it's worth considering, if what you're clear is that you have certain assets which are illiquid currently, or not the best time to sell those assets, and you're clear that in the next 3-5 years you'll be able to realize significant value, you should be okay doing a deal which is actually a PE deal. But if you don't provide an exit to those PE investors in 3 to 5 years, they have the right to force you to buy them out at a pre-agreed rate of return. Now, you have on one hand clarity that in the next 3 to 5 years you'll be able to sell these bunch of assets which are non-core, or passive investment sitting there, but not the best time to liquidate, etc. So on that basis, you may want to commit to such a deal, and definitely something you want to consider it and have a serious conversation with your investment banker or advisor as to whether to do this. Ratchet, I deliberately put this because, more so in today's time, you do a deal and then the valuation goes down in 1 year's time, etc. Many PE investors are very, wary about this. They will want a mechanism that if you end up doing a second deal at a lower valuation, then they want the right or the ability to average out their investment, so that it is good for them from their valuation perspective. And as Utkarsh mentioned in the beginning, you're dealing with the LP whose own income flow, so to speak, largely depends upon his successful exits and him participating with his GPs on the upside sharing basis. So that's why a PE investor will typically demand a ratchet clause to protect his investment value, so that if you tomorrow allow a dilution to happen at a lower value, he is able to come in and average out his investment if he wants to. I use the word caveat more from a generic perspective. The reps and warranties you will have to give, the covenants you will have to give. This can be significantly heavy negotiation issues. Best that these are dealt with in term sheets. I mean, I've lost track of number of transactions where term sheets are signed. These are not fleshed out well, and then the deal breaks through after having spent 3-6 months in negotiations of the documents, diligences having done, and expenses having incurred and whatnot. So that's why I use the word caveat here to more as a sort of a warning that these are things you want to be, have greater clarity upfront when those talks are happening at the term before the term sheet gets signed, etc. And you get clarity on this. What are the types of covenants or reps and warranties they will want? Indemnity they may want, etc. You know, foreign investors asking for anti-corruption protection indemnity clauses is standard, but other indemnity is something you really want to be giving a serious thought to. Now, I mentioned this tag or drag. What any investor really wants is a perspective that if you don't give him an exit and he finds a buyer, but the buyer wants like full control, he should be able to drag you. The other way around, you are not giving him an exit, but you are finding a buyer, then he should be able to tag along. So basically, drag is the ability of the investor to drag you. Tag is the ability of the investor to tag along with you. Now, we have put area of negotiation in the mean that you should be mindful of when you give the right to drag. Tag is okay. I mean, it's obvious, right, that if you are getting a better deal somewhere, the investor should be able to sell along with you. In a way, think of the takeover code, how it works. Promoter is selling, minority investor gets to tag along. That's what this is really about. Drag is, uh, my advice would be that you really need to be very cautious if you're going to give a drag to somebody who has a 20%, 30% stake in your company and you're sitting on the balance. But whereas, okay, you're sitting on a 30, 40% stake, that investor has a 30%, 40% stake or more, then I think a drag is definitely warranted. So that's why that area of negotiation we put up on the slide is the relative percentage holding and accordingly determining whether drag is really warranted or not. But yes, at the same time, don't make this a deal breaker. I mean, this is something you may have to live with down the line, but it's definitely worth negotiating hard enough on it. Again, I'm not going to spend much time on this investor expectation issues. For you to understand that some of the things which may get thrown up in the diligence or structuring, investors will expect rectification of it, and that rectification can be through by way of indemnities, reps and warranties, or covenants, or even giving you, okay, your factory is sitting on a land which the title is not in the name of the company for whatever reason, and this happens so many times. So they say, okay, we'll give you 6 months to ensure that the land, now the title really shifts to the name of the company from wherever it is. Otherwise, you have some damages kicking in or some, negative rights kicking in or what else. So sometimes the investor says, no, this is too critical. I would want the rectification to happen before we close the deal. What it means is documents are signed, but before the closing stage, they will want the rectification to have been done, and then only they will fund you. So that is what we call a condition precedent, etc. Otherwise, it's a condition subsequent. Some of these things can be critical, and again, the lack of licenses. What we mean is not that you're running your business without a license. Sometimes it happens that the license is held in one name and the business is being carried out in another name, and this is not uncommon. You're doing contract manufacturing within the group, or you had a factory originally in, say in the outskirts of Bombay, and now you're moved to Silvassa or something else, but you never shifted some of those licenses to the entity which now owns the factory and so on, etc. And one person in the family is owning one asset, but the another person in the family is owning the other asset, as I mentioned earlier, those type of situations. So sometimes the PE investors will be adamant, they'll make this non-negotiable, that everything has to be collapsed into one vehicle or one entity, etc. Now, one of the things we have seen here on the shareholding perspective, investors are reluctant to deal with 20, 50 shareholders or to sign documents. So they'll want an irrevocable power of attorney to be given to one or two people at the most. And we actually had a problem around 4 or 5 years back. A small cement company where a client came in, and typical large HUF structure, etc. And the Karta was given the power of attorney. And 2 years later, we get a notice saying, "Oh, but we had revoked the power of, we had done a partition rather of the HUF, so the power of attorney was not valid. This agreement is not binding, etc." It got into litigation and all of that, and these things spread around in the investor community, and that's why I made this point earlier. Investors are far more comfortable when the shareholding is held through a corporate vehicle, and they get apprehensive when the shareholding is held through individual names that includes HUF, partnerships, etc. Family trusts, it depends upon how the trust is structured, who the trustees and the beneficiaries are, and the correlation there. It is very subjective there. Again, further point of the earlier slide. Now, I think I'll cover 2 points here. Shilpi, how are we doing on time?
I think, Jayesh, we could take another 5 minutes, and then Paula will take another 10-15 minutes, and then we can open up for half an hour session.
Thank you for that, Ustash. Yeah. So this is one of the most contentious, and I say control of the investment and control of promoters. When I say contentious, this is where maximum negotiations end up happening. So I'm not going to get a detail of this, but I want to point out right now that this is something you really want to deal well at the term sheet stage, and also something you want to have a deep conversations here with the investment banker when you're giving the mandate, etc., to understand what the lay of the land is and what the investor's expectation will be. Not so much that you think you can not agree to all of these or many of these and get away, but rather where it's a family holding, and we are talking about family businesses, which means multiple shareholders, more often than not, multiple decision makers. The earlier you get clarity and insights on this, the better you have traction of negotiating within the family. Because I've seen this, and I feel very sad at times about the promoter who comes across otherwise all powerful, etc. But when you see within the family dynamics, he's really getting sort of battered from both sides. On one side, he's negotiating with the investor, potential investors coming in, etc. And on the other side, he has to manage the family expectations and all of that. And therefore, more than once I've seen deals getting stuck at the last minute because the promoter didn't know fully well, the key promoter that is, what he was giving into on day one. And when the agreement went to the other family members to sign, tantrums get thrown in, or they say, but you never told us this, or you're using this pretext of getting an investment to take away our rights and control and invest control in yourself and all of that. So this managing the process, even internal to the family dynamics, is critical, and I would say must be done at an early stage itself. And again, given our experiences now, we start flagging this when we see that our client is actually a family business in the sense of multiple stakeholders who have a say. Then the sooner they have these conversations, the better it is. And this is a point I make about both ways: control of investment and control of promoters. Like, for example, it's often common to see that promoters cannot dilute stake for the next 3-5 years, etc. Non-compete agreements. Now, challenges can be, while you and your brother are holding the shares, the non-compete will say, okay, your nephew also can't compete. But the nephew will say, but you know what? I have nothing to do with this business. I'm doing my own thing for the last 5 years. Why should I be bound by this, etc.? So all those you have to keep in mind. Forfeiture of shares, rare clause, but it is. I wouldn't be surprised in today's time we may come up seeing this more, where basically what it can mean is if your critical reps turned out to be false, or your key covenant was not complied with and is material, investor can have the right to effectively buy you out for a song, so to speak, which is why I'm calling it forfeiture of shares. So again, this is like putting, the muscle behind the reps and warranties and covenants getting meaningful. Exit mechanism, I talked about it earlier. I'll quickly only talk about right of first refusal and all of that, ROFO. These are complex mechanisms where investor will say that, okay, I found a buyer, now you have to sell out because you're not giving an exit. Whereas you'll say, no, I have a right of first offer and first refusal. So give me 30 days or 60 days. You need to negotiate this. I will go and find a buyer for your stake, and therefore you don't need this your buyer to come in, etc. again, last point on the slide, how, and then there are LPs and GPs to consider, which is what Utkarsh talked in a different context. Many a times, the person you're negotiating with is a general partner. He has his own dynamics. Just as I mentioned, you as a promoter have a family dynamics. He has his family dynamics, which is the LPs whom he has to report to, and his, charter, so to speak, of the fund, which has certain limitations imposed on him, etc. So whether they will appoint a director or not at a particular level of shareholding is also a function of their fund charter and all of that. And there are other reasons also why in some cases they will want a director, in some cases they'll say, no, we will want the right to appoint an observer, or we'll want to appoint right to appoint our choice of an independent director, which could often be professionals like Utkarsh or me or chartered accountants, etc., or even angel investors like Paula, who are seen as, independent professionals and coming in at the behest of the fund to act as sort of, you may see them as their eyes and ears. That is not the intent. The intent is really having a sense of professionalism on the board, which has otherwise been family run and family driven, so to speak. So I'll continue on the next one. This is very critical. When you are looking to do a deal, you need to think through, what are your long-term interests from a 5-10 year perspective, and then accordingly start negotiating and even look at the type of investors accordingly. Given your long-term, you may not want a pure equity right now. You may say, I'm okay taking hybrid. I have this other asset, which in 5 years time will give me this much value. And therefore I'm okay committing to buying out the investor on a pre-agreed return basis, because I'm clear that 5 years from now I'll have liquidity. So that is where this dilution versus control dynamics will creep in, and accordingly you choose the right instrument for investment. Disclosure list, our recommendation to clients is, and even we do this to investment bankers who come to us, that involve us much earlier, because it's better we help the client clean up the house, so to speak, so that when the investor comes in with his set of advisors, lawyers, auditors, other integrity advisors, etc., they find everything spick and span. Because I dread those transactions where I'm acting with a promoter and we have this long laundry list of issues and we have to clean it up. It impacts the valuation, it impacts management time and energy, which is better spent on, enhancing the
Absolutely.
business.
This is such a critical point. I'm sorry I'm having to jump in over here, but this is such a critical point.
Go ahead.
You cannot, after you have started conversations, if you try and clean up your shop, you're going to make a mess. So ideally, if you're going to go in for a transaction like this, you have to start thinking about it way in advance. Give yourself the runway to clean out the house, and then start engaging with outside parties. And that involves getting a lawyer involved early.
So investing in the lawyer and the new CA, so to speak, for a review to be done. Because see, you have an existing auditor who's doing a great job. That's not the point. You want, and you may have an existing legal advisor also. That's not the point. You want a new set of eyes to come in and go over your operations as if they're acting for the investor, and for them to find all the possible faults they can find. Because, it's like they find 90 faults. When the investor comes in, sure enough, they'll find 10 more faults. But imagine them finding 100 faults. So you're better off doing this upfront, so to speak. Confidentiality, non-compete dynamics, I mentioned about this earlier. And again, this is where you need to think through this upfront. Also, if you are thinking that, okay, currently you may manage with the current round of investment for the next 3 to 5 years, but after that you need further fundraising to be done, better to talk about it now and protect your rights accordingly, as against thinking that, oh, but the investor will be out by then and I'll manage, it will be taken care of. In current times, not a good idea. This is my last slide. Now, this is succession planning in family businesses, all the more critical. On one hand, we have businesses like the Dabur Group, etc., where family is fully out. And US, it's so common. The Ford and so many other companies which were started by a single founder, and then third and fourth generation were running it. The family owns a stake, but they rarely have any management ability, in the sense, sorry, let me rephrase it. They're rarely involved in management. So you need to be thinking ahead. And now increasingly we are seeing this, that the next generation is saying, we don't want to be involved in running the business. So think through now that what is it going to be 5 or 10 years from now as regards management of the business. After you want to sort of hang up your boots or spend less time with the business and get somebody else to run it, is it going to be somebody from the family? Position that now. Is it going to be from someone outside? Position that from now. Ownership related also. There may be somebody within the family saying that I want to be out of this, as in I want to sell my stake in the next 2-3 years. Provide for that upfront, because you don't want that, if your nephew is saying, okay, I have this 5% stake I've inherited, okay, because of my grandfather and all of that, but I am not wanting anything to do with this and I'm willing to wait, but after 2 years, I definitely want to sell. You don't want that to trigger a drag along that, and you can do it if you were to disclose that upfront. So again, I mean, we can spend a lot of time talking on this side only, but I just wanted to leave this thought. And with that, I'll end. And Utkarsh, thank you. And Paula, over to you then.
Thank you. That was, I think, very, very informative.
Sorry, I need to end the stop share. Yeah. Okay.
Paula?
Yeah, hi. Yeah, thanks, Jayesh. Utkarsh, I think a lot of ground has been covered and a lot of, details have been touched on how this happens, why this happens. When you infuse equity into an already running business and why we do it. So I think there's very little left for me to really touch upon except share some experiences. I will share my screen, but really I'm going to I think everything that I have here has been covered. So I don't think I really need to do much. Uh,
I think,
much
Paula, you
here.
will have some very, you will have some scars to show and some war stories to tell. I think that will be very useful from all our perspectives.
True.
Yeah, so I will just go through this, but and maybe just talk about touch upon everything that has been covered with some anecdotes. So I think we talked, I think right from the beginning when Ashish talked about why equity investment in general. And we understand that it is really not just replacing debt, but actually enhancing your company's value when you bring in equity investment. So you are doing it for non-linear scaling. Or if you are doing it because you're in a dynamic field like a technology based business, or your company is pivoted and this you cannot sustain the kind of model that has gone on for generations, and typically sometimes replacing, sometimes augmenting all the debt that you've taken to grow. And I think Jayesh covered very well as to how one can protect all the terms or onerous terms that you might get when you infuse equity or some into your capital. And it's very hard for family businesses to take that. So I remember talking to a family company that where the son really wanted to do things differently. There was a huge opportunity, and he actually because understood that the old business, though it's a very strong brand and it's going to be an ongoing business, will never become non-linear in the context of today. Maybe a few decades ago it was a non-linear growth in those times, and they were able to build a brand that was valued, but the valuation would soon deplete. And some of the younger generation people had recognized that. So he was pitching to us for funding in a pretty traditional business, which he was going to pivot into a more technology-led business. Um, and we went through a good advice. I mean, he had a good advisor. We went through, um, all the terms and so on. But exactly what Jayesh said, when it came to the final board, we were invited to pitch to the board the new plan, which was very well, all our people had gone through the plan. But it was really strange that actually the patriarch of the company was sitting in another cabin and actually telling his CFO, no, this will not do. It is showing so much loss. We need to go in a particular way. And, so basically the risk profile was different. The equity investment was funding a non-linear growth, which obviously had some risk. The risk was not as much to the balance sheet, but in the minds of a traditional business person, that there was a strong risk. And he was, the promoter, the key promoter who was driving it, was the son actually of the founder, was not able to, really get this through with the other stakeholders who preferred a safe organic growth simply because that's what they'd seen. And one had heard all kinds of stories about the terms that, Jayesh touched upon. and they had very good relationships with banks, and working capital was all lined up. So the need was not seen. So the key thing, the starting point has to be just to understand why do you need the equity investment. It should not just be for a glamour of bringing in a name or an institutional player in your cap table, but really every stakeholder must understand what value you're going to unlock by getting this growth capital in. Um, and recognize that lots of industries right now, and we know that this is going to happen in even things like retail as we speak. If you don't change today, if you don't infuse investment which are going to enable you to put technology and other resources, you will not survive in the traditional retail model, for example, in the post-COVID world. So it's going to be a rapidly and drastically changing model. So you will need a value-added investor who will bring in the experience along with the money, also clean up, the debt in your balance sheet, and have some risk mitigation. So like the business stopped for 3 months for many of the retailers or many other businesses, if you had access to some equity capital, you would at least be able to survive and plan how to use that capital in a different way. Very hard to do it with debt funding, which is tied so much to your month-on-month performance, etc. So, I mean, this is the crux of it, right? You have to understand that it is really smart capital that you are bringing in, and all these things have been touched upon. So I'm just going to bring in an example of a traditional commodities spice company, which recognize that the whole food scenario in India is changing. So much of this QSR is coming in, so much consciousness is coming in on what goes into food, on the ingredients, etc. All these deliveries had started. The whole food scene had become like a food tech scene, dark kitchens coming. So, they wanted to get money to expand, to also try out some models, take some risks. So they did that, and I think from just 3 factories and a few people, it became now I think 14 factories and large number of people and large segments that they're addressing. So their business model from their traditional business of just commodity selling and then packaged food selling, from B2B, they've got B2C presence, they've built up a brand, they're supplying and all these dark kitchens. They're able to bring in professional management uh, and attract talent so that they can manage this transition. They've gone global. Obviously they've increased their efficiencies and so on. So the whole goal of long-term value creation happened. It was not that, all PE guys just want to come and do Excel sheet arm twisting and push you towards an exit. I think Utkarsh said in the beginning, the value is created when you build a business, not when you sell it, right? So if you must ensure that what you're getting is smart capital, which can help you build the business. And again, this has been touched upon, but very important point for family-owned businesses, that when you bring in equity capital, that is really going to release liquidity and allow for succession planning, allow for different structuring, allow to take out a small part of a business, of a large business, which may have a lot of value to unlock, which you can't do today. So let's say you take out this business, which may have some technology that you've developed, say for your retail business, but it has its own potential, and it will, not be unlocked if it stays within, just for use within the company. So, another company that we funded, a small part of a logistics company, they developed an excellent technology platform, was spun off. And, that equity was also used for family restructuring, succession planning, etc. And just one part of the business is where the PE people invested, but that unlocked a lot of liquidity for them to restructure themselves. That company, was able to go public because they started thinking in different direction. It was a very rapidly changing scene, and they were able to act on it because they had access to this kind of capital. Um, and also it took away, this generational stress and strain that was there. There was the bunch of people who continued to run traditional business, and two nephews actually spun this off and were running it very differently than the original business. When they did, like Jay showed, they made sure that while some ownership was protected, the management was taken out. The key decision makers, key man clause, etc., was changed so that it was run very professionally. And a very key thing is that, by and large, family-run businesses, there is hardly any segregation of ownership, management, and whole approach towards business. It's all together, right? There is no segregation. You own the company like your own. The company has no identity of its own. I think when you bring in an external professional partner, the segregation of ownership and management, ownership and decision making is pushed. And that again propels it into a different orbit. Now, of course, there are a lot of reasons why you will be skeptical about getting somebody else on your cap table. Why sell the family silver? And some of the things, terms that you will see on any term sheet are pretty daunting, and you would really wonder why one would want to, take on these things and, encounter scenarios, some of which Jayesh outlined, in some bad scenarios if you don't perform, and or you have to keep performing to maintain your cap table, your percentage of ownership, control, and so on. So why would you take on this headache? Of course, some of the reasons we mentioned why you would take it on. Regardless, you have to be very cautious, right? So you have to make sure that the terms are not unreasonable and onerous, on performance linked things, for example, on keeping reasonable control, because you have invested so much in that company. You know the ecosystem on the ground. You are worried that these investors are only Excel sheet people. They only want to do numbers. They have no idea what happens on the ground. How do you actually go and sell to a customer? How do you get terms from a customer? How do you build out a full ecosystem or your supply chain? And what happens when a supply chain breaks, like it has happened right now? It's only the entrepreneur on the ground or the guy who's executing knows all these things. The PE guys, they're running, advising 20 different companies. So it's perfectly well, perfectly reasonable to be skeptical of these people. I think the key here is, if your goals are not aligned, there can be a lot of friction, and then all the onerous terms will kick in. So why not is, you don't do a deal if you feel you can't trust the investor who's coming in. If you feel that you have not been open and transparent, and you've not been able to share everything, including all your issues or challenges that you may have, if you don't think you can build on that trust together, I think it's a very bad idea to do it. So a goal of say a PE guy, again Utkarsh mentioned that PE people also, we have our LPs to whom we are answerable. We have to give them returns in certain period of time. So let's say a PE firm which comes to you has only 2 years to close the fund or give returns. There will be unreasonable pressure on your company maybe to give returns, unexpected unreasonable returns. So in those scenarios, you have to be careful that they have to be, in the excitement of doing a deal, you should not promise the moon. So again, be very transparent, have strong accountability to the investor, but also make sure the investor understands all aspects of your business, the challenges as well as the opportunity. And yes, things will change for the company. There could be interference, and one of the companies that I know took equity funding found it extremely difficult, because while it was a family-run company, one of the members had built it really, was very strong, knew all the things on the ground, and just did not trust the PE guys to make any decisions or even give suggestions. So he was just like, this is complete interference. I'm losing my independence. I'm only working on, I'm on the razor's edge for meeting projections rather than looking for opportunities. This is not going to work out, and actually got out and actually did a buyback by taking investor who could help bail out. And you've heard of these kind of cases where it happens. So again, it's a breach of trust and faith, right? You don't understand each other's goals. Because things will change. You will lose independence. Will be a razor's edge for accountability, for performance, and so on. So you have to prepare yourself. And again, like Jayesh had said, be ready before you start. Let your advisor prepare you. Be upfront. Disclose all your issues, all your balance sheet issues, etc. So that post the deal, one should have it all figured out before you actually looking. Now, valuation is always a key friction there when you start, because you dilute your stake. And remember that value is not, will be in a band. Anybody will give a band based on what's going on in that ecosystem, what your numbers are, what your projections are, and so on. So I feel as an investor, valuation is usually made into a bigger issue than it should be. I think both the investor and the promoter understand that if there is really value to be unlocked, there is valuation which is fair. So one can always come and again, like it was said earlier, one can always have clawback ratchet options for promoters who are executing on the ground to earn back, some of their, dilution, and for the investor to protect some of the downside. So these things can be worked out. But I think the key thing is to avoid boardroom battles, and this comes because of lack of transparency and control. And on one of the companies, logistics company that I was talking about, the boardroom battles have become so bad because of complete strategic misalignment. And the promoter actually took away the decision-making power of the key promoter who had negotiated the deal. So that person is vanished. So the investor group and the promoters are only battling because we are completely at loggerheads on which model should be executed. We had not funded what they want to do. They don't want to, execute on what we want to do. So again, the strategic misalignment also, all this has to be cleared off before you get into bed, so to say, right? So in your, when you are dating with the help of the advisor, you must mitigate some of this and have a lot of clarity on this. And if you think now from the investor perspective, I get into a family-owned business. We have outlined that there could be issues of all these family dramas and, decision making and so on. But like Ashish said, 79% of our GDP comes from family-owned businesses. They have a pretty good growth rate. They are quote unquote banya people running it. So they have absolutely the hand on the pulse of the market. They know daily what is going on. So it's usually a very solid business. There's a lot of opportunity to unlock. It's an unrealized potential. Very solid ground business. There is potential for going for something like an IPO or very attractive, global acquisition and so on. So the investors are looking for, these entrepreneurs with the caveats that we made earlier of family interference, complex holding structures, non-professional approach, lack of transparency. All these are red flags that we need to sort of breach. And that's with the help of a good advisor and lawyer can do that. If you can get the alignment of goals. The investor will need some path to exit. The promoter will have to be open-minded to new strategies and bring in new professional management. At the same time, I think as investors, we have to give the due to the person who's executing, the team which is executing on the ground, and their understanding of the market and the dynamics of the entire ecosystem. I think if we as investors come in saying we know it all, we know the best because we have investment, we have the money and we have invested across so many companies, then I think there is, it won't be fair because you have to give due to somebody who's built the business, who has really, hit the road and, managed to build out or sustain whatever the family business may have been. So, I mean, just in summary, you have to make a win-win. We have to have the ability to let go as promoters, and also as investors, we must have ability to let go. Can't we control freaks? You have to have very clear decision making and a joint decision making path. goal alignment and mutual trust. The math can be worked out. After all, Excel sheets can be changed. You can always justify any valuation or do things to protect moat out the valuation, so on. What you can't do, you can't create chemistry and you can't create trust just by putting it on piece of paper or bringing lawyers. Um, it must be win-win because you're creating value for everybody. And if that is the case, only then bring in an investor. And similarly, for the investor to get into a complex holding company and do all this paperwork, it has to be very clear that there is huge potential to be unlocked and that we can work together on it. There is a company which is into auto dealership, and they were the first company to take in PE investment. And the reason they took it is most of the other businesses were asset heavy. They were investing into large real estate for their car showrooms, etc., and then leveraging that asset to bring in more debt. And the promoter was knowing every day what the cash is and so on. It became so onerous when things changed and things opened up and a lot of competition came. Uh, those kind of asset heavy, they could not expand anymore. Whereas this entrepreneur who early on took funding from VCs actually like us, and then got PE funding and went with an asset light model, but is now the largest dealer in the country, has got a large insurance business also funded by the same people. So they unlocked a totally different set of values. And there was key alignment on this, that we will do things differently. So there was ability to take risk, but with full informed decision making process, and the ability, have the agility to to pivot when required, and respond to the market. So what this we sort of bring to the table is just this ability to think little differently, to take opportunities and unlock potential. As entrepreneurs, we always want to protect what is our own, what we have built or what we have been given, and we've had a role in building out. And it's very hard to get somebody else on the cap table who's just bringing in money. So if it's just money, stick with the traditional sources, bring in smart money, smart capital with the right terms, get good advisors, get good legal help to protect yourself. There are horrible stories of boardroom battles or beyond, right, where things have gone, where CTOs, CEOs have been chucked out, the promoters have been thrown out, and the investors bring CEOs, and then the teams. There's a kind of chaos. So it can be a recipe for disaster. So I think how to mitigate that is a key. But one can't be complacent, right? I think you have to see the positive and growth stories which have come out of this all across the world. And it is really the best form of capital. Should not make you complacent. Of course, we have stories of where people have so much money in the bank that they ignore the fundamentals of business 101 and don't look at EBITDA, don't look at profitability metrics and so on. And at some point they collapse. So this money is not free money. You've actually parted with equity, which is the most expensive kind of capital, really. So when you have it, value it. Don't use it loosely. And we have seen some examples of people just torching their way through, right, of burning capital. And it has happened in a lot of the newer models. By and large, family business are very conscious and very conservative, so it doesn't happen. But the point is, when you get access to capital, sometimes this happens. And this is another thing one should really be careful, that while it is somebody else's money, the value you are unlocking is in your own company. Whether you own 40%, 60% or 80%, it is still the company that you're wedded to. So value that capital, value your own dilution, and be very, very accountable to the business that has created this new capital. I think with that, we should just open up. I'm sure there are some questions. So Selby, over to you to bring in the questions, and we are here to take them.
Thank you, Paula. Thank you, everyone. May I request people who would be interested in asking questions to raise their hand so that I can come over to you. Before that, we have few questions in the chat section. I had a bit of an internet problem in between, so I don't know whether the question has been addressed. So please help me in telling if it has been already addressed. There is one question asking what kind of due diligence do PE undertake?
Sure. I think I'll just start it off with that. I think the main point over here is what was covered both by Paula and by Jayesh. I think the due diligence that private equity firms conduct is very thorough, and they go into all aspects. I will not repeat what Jayesh had already covered, but all aspects in terms of what is the nature of the ownership, what are the dynamics of the ownership trust or individuals. What is the nature of the business? What is the nature of your contracts? Examining those contracts, uh, what is what is the status of your holdings and your assets, examining the ownership of the assets that you have. So basically no stone is left unturned. What is the going back and looking at your audited results for a few years, comparing that, getting them independently audited, making sure that there's no hiccups over there. So I think the short answer is that your disclosures to the potential investor is going to be complete and absolute. So the way to make sure that that is a comfortable situation for you is to start the process early and make sure that there is nothing that you don't want to disclose. You will not be able to not disclose something. You will be having a full disclosure, and therefore you need to get your house in order. Going back to Jayesh's point, engage with advisors early so that you're able to be prepared for a transaction, 6 months, year, even 2 years down the line.
Okay.
One thing I'd like to add is also, you should also bring in your own senior team members into confidence. They will be subject to due diligence, so it's very important to have them part of this whole exercise as well.
Absolutely.
The addition to this same question I feel is, how are PE firms using due diligence to gain advantage over their competitors? What about the offshore impact on the domestic market?
Sure. And Paula, you want to start this off and then I'll add something.
Yeah, so I suppose what you mean is that, you can use this due diligence to
Gain advantage
over your own competition. It means over other companies in your portfolio. I think that's, not correct if they're just using the due diligence for, their own portfolio and so on. I think they are just using the due diligence to make their own judgment about what they are getting into. It is, there are usually NDAs, etc. But obviously one should not, if you feel that there are many competing portfolio companies, and one should make sure that there is some non-compete built in. And maybe Jayesh can talk more about it, but I'm not sure what you mean by offshore impact on domestic market. So there are.
He's just put what about the offshore impact
I'm
on
not
the domestic market.
clear on what he means there. But.
Okay.
Diligence part, what we're increasingly also seeing is investors want a full supply chain diligence to be done, including from an integrated perspective. Are there hidden related party arrangements, etc., or the robustness of the vendors, etc. So on both the cost side and the sales side, both key customers are being sort of reviewed, and more importantly, the key suppliers are being reviewed, and then with consent, diligence being done on them, etc., and then being spoken with. So that is becoming increasingly important. Maybe that's the question they were asking about, using it for competitive advantage. That could be the aspect. I'm not sure about that.
And also, I think there are good players and bad. 90% of the times you will encounter good players who are, who will be respectful of the information that you've got. But yes, one cannot say unequivocally that there is no risk to that. I think what's very critical is, again, planning up ahead on and knowing what you want to share in terms of things which are critical. If, for example, pricing information can be sensitive. So making sure that you evaluate the company, the private equity fund that you're having a conversation with. You have an understanding of whether or not there is a direct competitor who is in their portfolio company. What are the aspects that you want to share, assuming that the worst happens. So I think planning around that, and at what stage you share what information, whether you get to a certain level of comfort, whether you get to a certain level of commitment before you share certain kinds of information. I think that planning is very critical.
Utkarsh, there's a question to you. Can the growth fund include encashment of the promoter along with organic and inorganic growth of a very successful company?
Sure. I think again, this is something that Jayesh covered briefly. Uh, yes, it is possible that a growth equity fund does come in and give you as a promoter an exit, but it is not the preferred method. Let's look at it this way. I think that the only reason a private equity player would want you out is if they feel that they can do a better job and create more value for themselves with you out. Therefore, if you are running the company well, and that is the reason you're having that conversation, and you want to get capital to make it become bigger, then a private equity player will not get a lot of comfort knowing that you want out. They would typically want you to have skin in the game. Typically, they would want you to be invested in the long term, and they'll have some covenants to make sure that you cannot exist. But that said, there are definitely cases where you can, sell 70, 80% of your company. Typically, it's not in a one go. Typically, that happens if you've, reached all the key milestones and there's nothing else that for you to do. So I would say it is atypical, but it is not impossible.
Okay. There's one more question, whether PE should invest in trading businesses.
Whether PE should invest in trading businesses.
Yeah.
That's a very specific question. I don't think I can answer it, but I think typically, um, a PE fund would invest in a trading business if there is some defensibility, right? So if you are replaceable, and if the only aspect that you're competing on is your how low you are on your margin, then that is not a defensible business. But if you have some defensibility that the private equity can grow and use that as the base to get more companies under your umbrella and drive value creation in the long term, then yes, why not? But I think typically, if you look at the perspective from a private equity company, they want to make sure that they have visibility into many years of revenue, and they have some defensibility around that. So if you have a business which is just the only differentiation that you have is the ability to undercut somebody on price, then that's not a strategy which is a very sellable strategy.
One question is, how important is the size of family business for PEs to start getting interested? It is only about sales, or is it about sectors, growth potential, history of founders, etc.? Meaning, is there a family business that might be too small for a PE to be interested in?
That depends on the ticket size of the PE that they typically invest. So obviously, if it's very early stage and if it's family owned, then it's a venture capital kind of seed, early Series A kind of thing. They're usually typically you need very nonlinear growth at early stage. So if you've been a very slow growing business and you're at a small number over a long period of time, usually that will not attract any PE investment unless you have a potential to really grow non-linearly because of some perturbation either in your business model or external or internal. So typically you would either need a very strong potential growth if you're a small company, or if you just over a period of time you've been a trading company, it's only reached a very small number, then likely that it will not. Again, there's no cookie cutter answer for this, but typically, obviously, you are looking to unlock value. So you want non-linear growth. So any company which is potential to have non-linear growth, a smaller PE fund or smaller VC fund could invest, but clearly there has to be unlocking of value in terms of non-linear growth potential. It will not be, if it's just for working capital to grow at under 20%, nobody's, no PE is going to be, or VC is going to be interested.
Right. And I think just to add to that, I think it is a very competitive space. To get private equity funding is a very, you have to pass through so many hurdles to be able to get there, that, a private equity fund will only get, make an investment if you are, the best of the best. And part of that is also a function of scale, because I think most of the private equity funds make sure that they don't invest in too many companies, because their ability to manage companies becomes, exponentially lower if they are very thinly spread. Therefore, they want to put their capital into a few, deals. Typically, most private equities won't put more than 10% in any one deal. So as a rule of thumb, you will have any fund deploying into 20, 25 companies at max. In the private equity growth equity stage, in early stage venture capital funds, it's a lot more, but private equity is more oversight driven. Therefore, you will need to be, since the amount of capital involved is very high, you will need to reach a certain size, and you demonstrate the fact that I've been able to get here on my own, and that is why I need private equity now to get to the next level. So yes, size is.
So I'll tell you.
Sorry,
So we've invested, for example, just to add to what you were saying, just to give an example, we invested as a venture capital fund into a chain of dental clinics, and they had only had two, but they had a plan, and it was a father's, two brothers and a father who were running it, but they had a plan to show nonlinear growth. So we sort of came in as early venture investors, and then very quickly got growth PE guys in, because we were showing very large growth. Right. But as VCs, we took a bet, and though it was a family business, but they were very well poised. They didn't want to grow the traditional way, and it was a newer company. It wasn't like it was going on for many years. The sons had come and sort of changed the business that the father had started, and very quickly they were poised for growth. So I think the growth rate is a key here. How fast you want to grow, and what model you want to adopt to grow.
The hustle of those individuals would have also really mattered, right? So I mean,
yes, the hustle is the key. Yeah, that is what you don't have much diligence to do at that stage. There were two clinics, so there wasn't much diligence to be done. We were just betting on the hustle that they were bringing and the vision that they had, that they would have clinics within 2 years, and they actually performed on that. And then we had PEs lining up.
Absolutely.
One question is, do you see family business contemplating PE funds should have a vision of listing for their companies? And one more is, why should one choose a PE over a strategic investment?
Sure. So the first part, yes, you should plan for, some kind of an exit event, which we covered earlier in my section, because private equity puts in money because they're looking for an exit a few years down the line. An IPO is one of those mechanisms, but as I said, there are other mechanisms as well. But you can rest assured that an exit event is warranted. So if you think that if you plan not to have an exit event, then private equity is not the right approach for you. The second part of the question, sorry, Selvi, could you repeat the second part?
The second part is, why should one choose a PE over a strategic investor?
Okay. I think that is a very individual question. Typically, you need a strategic. You are eligible for a strategic once you get to a certain scale. To get to that certain scale, you need private equity. So depending on your sector, a strategic will buy you out either because you are giving them a segment of the market or a product line or something which they don't have, or they are in that exact space and they want to consolidate you and become bigger. So in both those cases, getting to scale is going to require some form of capital. And as I said in my section earlier on, just debt alone is not enough to get you there.
Imagine if Google had sold itself to Microsoft.
Exactly.
It would have been a strategic, right? It would never have unlocked the full potential. So it is a question of timing. Facebook is investing now in Geo as a small investor. It is not coming in as a strategic here. It is strategic, but in a very different way, right? So I think early on, it's probably when you get in a strategic, you're sort of ending your game and giving it to somebody else.
One question, would be the last question I would take due to lack of time. How important is industry structure for evaluation of businesses? At what stage is it undertaken? And steps typically taken to ensure constant quality deal flow?
Sure. Paula, you want to start with that and then I'll just chip in?
Can you just repeat?
How important is industry structure for evaluation of businesses? At what stage is it undertaken? Then the steps typically taken to ensure constant quality deal flow.
So how important is industry structure means, I assume that you mean the, how the company is structured?
I think they mean industry dynamics,
Yeah, Mr. Ghosh, you can just ask the question.
By industry structure, I meant was suppose it's a commodity business, like say sugar. There's not much
Ah,
of a differentiation thing as opposed to something else. So that's the industry structure I'm talking about.
yes, so certain industries certainly are more conducive for PE investments.
Exactly.
I mean, again, there's no cookie cutter answer, but definitely the industry structure is extremely important. What's happening in the industry, how that industry is moving, whether it's a fast growth industry, whether it's sort of a sunset industry, what are the typical P multiples there, in the listed companies, uh, how that whole ecosystem is viewed. Is it export oriented? Is it very inward looking? Whether talent is available in that. So that is a very key. So PEs certainly work in sectors. There are PEs specializing in healthcare, retail, all kinds of vertical, right? Real estate. So extremely important, and one should get a PE, an investor who knows that industry well. And steps typically taken to ensure constant quality deal flow by investors is just understanding the industry, being out there. The only way we can advertise ourselves is through our through the founders in whom we invest, right? So the companies, how they perform, and how the founders stand up for the relationship or the value that the PE guys brought in, the investors bring into the company. So that is really the hallmark. So before taking in investment, the founder should check on the credibility of the investor, and it's really through this that the quality deal flow is maintained. Of course, the analysts and in industries that you are active in, you have to be out there, meeting people and looking at different deals, doing events, giving strategic inputs, engaging with different industries. Of course, all that ensures deal flow. Utkarsh, you want to add anything?
I think just simply that typically a private equity into company, when they're evaluating you, they also have to make a presentation to their investment committee, right? And when they're making that presentation to the investment committee, they need to sell the company, they need to sell the industry that the company is, and they need to sell the overall macroeconomics that you are subjected to. So therefore, industry is very important. What are the dynamics of the industry, what that industry is projected to do, what is the competitive landscape within that industry, how do you fit in within that competitive landscape? Those are all questions which are going to be very critical. And as Paula said, most investors have know certain industries better than others. Most investors have certain thesis on certain in industries, and it is not a consistent consensus driven business. So if everybody thought that the same thing is going to do well, then there was no opportunity to make money. So you have to find the person who believes who has a thesis about your sector, your space, and your company, which is almost the opposite of what others feel, or different from what others feel, and that is how they are planning to create value using you.
Thank you.
I just wanted to add one thing. I saw one of the questions which I think Selby missed out, which I think is a very important one. And just to answer that, the person was asking the questioner that why, since the 0% interest rate in Japan and in the US, why don't people approach there for funds? So I just wanted to add there, I mean, with your permission, that I think they've forgotten about the exchange risk, so that's what I think the answer. Utkarsh, if you'd like to please answer that, that'll be
True,
great.
true. And I think, the low interest rate regimes globally, not just in Japan, but US, Europe, everywhere, is driving the flight of capital to places like India.
Yeah.
But it is not happening at the company level. So what happens is that, if you are an institutional investor in the US or Japan, and you want to make sure that you get some returns, putting those in, fixed income options is less attractive in a low income environment. Therefore, what you're going to do is you're going to find other, asset classes to put money in. One of those asset classes is private equity. You're going to think about the market where you can get that, the most bang for your buck, and therefore India becomes an attractive market. Or even debt instruments in India. You're able to get more money out of a debt instrument in India than you are in Japan or US or Europe. So therefore, it happens at an institutional level rather than at an individual company level. It comes to a fund manager in India, and then that fund manager deploys that capital, which is how it gets to the company. So
But on the flip side, as a fund manager, when the currency risk is also there, when your capital has come from, when rupee is depreciated. So my first fund, So first drawdown was, believe it or not, was at 40 rupees to dollar, and we to return the capital at 68, 72.
Right.
So you have to really work much harder.
How long back was that? Because it's almost double today.
2006 was the first drawdown. Yeah, and we returned, just 4 years ago.
But you returned at 76 bucks.
Well, it was 668, I think, when we returned. But this, yeah, it will be at, God knows, 80 rupees now.
Amazing. So all the value creation that a private equity person does can get wiped out because of the currency risk, challenges.
You're absolutely right. I'm in real estate, and we were the first company, one of the first in 2007 to get FDI investment in our project.
Right.
And surely in 4 or 5 years, when we completed, it was a fund called Sun Apollo. And when they exited after 5 years, we gave them almost like 2.5x money. But because of the exchange, he said we made hardly 10%. So I said, what can I do about that?
True.
It's an external risk.
Yeah, that is an external risk.
Absolutely. That was a fantastic session, but I must say, thank you so much.
Thank you.
So as we move on to the end of the session, this very wonderful session and knowledgeable session, may I request Mr. Ajit Mangrolkar, Director General, IMC Chamber of Commerce and Industry, to conclude the session by presenting the vote of thanks. Over to you, sir.
Thank you very much, Selby. Good evening, ladies and gentlemen. I am quite certain that all of us have been very, very engrossed in what has been an excellent session. And in fact, I compliment Utkarsh, Jayesh, and Paula for sharing their extensive domain knowledge and expertise in the field of equity funding and attempting to unravel in a short span the complexities of the underlying issues. On behalf of IMC Chamber of Commerce and Industry, I also like to thank all three of them and the IMC Startup Committee. Thank you, Paula, for this fantastic session and for taking this initiative and putting forward a brilliant session for IMC. In fact, in this age of webinars and where people say we've got a Zoom fatigue going on, it's actually sessions like this which, boosts us again, because, it's so very niche and something so very interesting that probably on a daily basis, we may not get to see this, but in the current environment, really, thank you so much. Thank you, Utkarsh, Jayesh, and Paula. We've really been, very engrossed and intrigued. And I trust all the members in the audience had a good session. I thank all of them. And of course, I thank Selby for putting this together. She is the glue that puts all of this together. So thank you very much, Selby and your team. And thank you once again for sparing your time and giving us your valuable insights. Thank you very much.
Thank you so much.
Thank you. Thank you, Selby. And thank you.
Thank you.
Selby,
Thanks, Ashish.
Thank you.
It was a pleasure.
Thank you very much. Thank you, friends, for your kind cooperation, patient hearing, and active participation for a wonderful session. Thank you very much.
Thank you.
Bye. Thank you so much. Bye.
And thanks to Utkarsh for curating the whole thing.
Yes.
No, my pleasure.
Yes, Utkarsh.
Thanks,
Thank you so much. Thank you.
Absolutely my pleasure. I'm so glad that we had the opportunity to speak to so many of you.
Thank you very much.
Bye. Namaskar.
Bye-bye. Bye-bye.